Let's take a look at problem 6-1. In this problem, we have 5 different situations. Each of these are unrelated to the other, so we can look at them individually. We've been told, unless instructed otherwise, round answers to the nearest dollar. Interest rates are per annum unless otherwise indicated. On Jan 1st, 2017, Fishbone Corporation sold a building that cost $250,000 and had accumulated depreciation of $100,000 on the day of sale. We received a consideration of $240,000 in a non-interest-bearing note due on Jan 1st, 2020. There are no established exchange price for the building, and the note has no ready market. The prevailing interest rate for a note of this type on Jan 1st, 2017 was 9%. At what amount should a gain from the sale of building be reported? So in this case, all you're really looking for is what's the present value of this note. These two amounts are not relevant for calculating the present value of the note, but it is relevant for calculating the gain, which is the final answer we need. So let's start writing down information that we've been asked to present over here first. So to start with, the original cost. The next one we're going to look at is accumulated depreciation. Those two numbers were given to us. And the next couple pieces of information I want to highlight here are what has been given to us. The notes receivable is $240,000. The interest rate is 9%. That's given in the exercise. The date of the note and the due date are given to us. So how long do I have the note for? That becomes the term of the note. The term of the note is 3 years. And why is this significant? Because I'm going to use the interest rate and the term to find out the present value of the note. I will get the money 3 years from today, a single sum. So I'm interested in the present value of an ordinary annuity. So I'll set up my journal entry over here. In my journal entry, I know notes receivable is going to be debited. That's the money that I'm going to get. That's the present value I need to calculate. I know the accumulated depreciation and the original cost of the asset. When I sell an asset, I need to take it off my books. I carry assets with a debit balance in my books. To take it off, I credit it. Accumulated depreciation is a contra asset account that exists in relationship with the asset. In order to take off that account, I'll have to debit it. So these two numbers are known in the problem already. So I'll enter that information. How would I calculate the present value of the note? The present value of the note is going to be calculated as this number that we have over here. I'm going to highlight it. Multiplied by the present value factor, which we looked up on from table 6.2. That's the present value of a single sum. So $240,000 times this present value factor will give me the present value of the note. Present value of the note plus accumulated depreciation must equal building. If it doesn't, it means I have a gain on sale. So the difference that I record over here, this is the final number that the problem is asking me for. What is the gain that is going to be recorded on when I report the sale of building? So the final answer is $35,323. So I had to find the present value of the note in order to answer the question. So all the information given to me was relevant in the problem to get the final answer. Let's look at the second part of this problem. In part B, we've been told on Jan 1st, 2017, Fishbone Corporation purchased 300 of $1,000 face value, 9% 10-year bonds of Walter Inc. The bonds mature on Jan 1st, 2027 and pay interest annually beginning on Jan 1st, 2018. Fishbone purchased the bonds to yield 11%. How much did Fishbone pay for the bonds? So the question really is asking what's the selling price of the bonds. In this case, I'm the buyer, Fishbone is the buyer, so they're asking me how much should I pay for it. 9% is the bond interest rate. 11% is the market interest rate. So I will have to calculate the present value of two numbers. I'll calculate the present value of the principal and the interest. How much is the principal? The principal is 300 times 1000. The interest is 9% of 300,000. 9% of 300,000 gives me 27,000. Now, each of these I will multiply by the relevant factors. When will I be repaid my principal? At the end of 10 years. It's a single sum. When will I be paid interest? I'll be paid interest every year for 10 years at the rate of 9% at the end of each year. So for the principal, I'll look up table 6.2, present value of a single sum. I look up the factor and I calculate the present value of that number. I do the same thing over here. For interest, I look up table 6.4, which is present value of a series of cash flows for the ordinary annuity. Again, do the same thing. After you find out the present value, you calculate the extension, which is simply multiplying the amount with the factor. This finally gives me the answer I'm looking for. What I paid for the note is 264,666. Again, 264,663. Let's step back for a second and see if this makes sense. The bond was paying 9%. I could have put the money somewhere else and gotten 11%. The only reason I bought these bonds is because I managed to get them at a discount, which means it's less than the face value, and that in fact is correct over here. Now let's look at Part C. In Part C, we bought a new machine and agreed to pay for it in annual installments of 4,000 at the end of each of the next 10 years. Assuming a prevailing interest rate of 8% on the contract, what's the cost of the machine? So fairly straightforward over here. What we're looking at over here is the payments that I'm making, how long I make the payments for, and what the interest rate is. Okay, since it's a series of cash flows, payments are made at the end of the period. I'm looking at present value of ordinary annuity, which is table 6.4. So let me write down all those numbers. I have $4,000, 10 years, 8%. I look up table 6.4 to come up with the factor 6.71008. All I need to do over here is the journal entry. They haven't asked for the journal entry. They're just asking me at what amount should you record this. I'm going ahead and showing you the journal entry. So it's going to be on the date of purchase. The date was not given. I'm assuming it's 1/1/18. The machine will be debited at the present value of the note. The present value of the note is 4,000 times the factor. That gives me present value of the note, and that's what it's going to be recorded at. Okay. Now that I've seen that, let's see what Part D has and how it is different from the previous one. We purchased a special tractor on December 31st, 2017. The purchase agreement stipulated that we should pay $20,000 at the time of purchase and $5,000 at the end of each year for the next 8 years. The tractor should be recorded at December 31st, 2017. Assuming an appropriate interest rate of 12%, they want to know what the amount should be. So this is different from Part C in that there are two payments. Here it was only a series of cash flows. Here it's going to be an upfront price and a series of cash flows. So essentially, we'll be doing the same thing as we did over here. With a slight difference, I'm going to go ahead and show you all the numbers up front and explain this to you. I have one upfront payment of $20,000, and then I have annual payments of $5,000 at the end of each of the next 8 years. The prevailing interest rate they've told me is 12%, so I look up the present value factor. Now, why didn't I do the calculation as in over here? This $300,000 is paid at the end of the period, at the end of the term of the note. Here it is paid upfront, so the present value is $20,000. I don't need to do that separately. So let me show you how my journal entry is going to look like, what my journal entry is going to look like. This should be December 31st, 2017, because that's the date of the note. Okay, so I will debit the asset tracker just as I did over here. I will debit notes credit notes payable, and I also credit cash because cash is paid upfront. How much cash did I pay? 20,000. So I credit cash 20,000. How much will I credit notes payable? Just as I did over here. Notes payable is calculated as present value of the series of cash flows. Here in the previous case it was 4,000 times 6.71008. Here it is 5,000 times 4.96764, giving me 24,838. Now if all they asked me was what's the present value of the note, this would have been my answer. Here they're asking me how much would I record the tractor at. I would record the tractor at 44,838. So you're combining these two amounts. The present value of the cash paid today, it is what it is, and the present value of the notes. Here it was only present value of the note. Now let's look at part E. In part E, they're telling us you want to withdraw $120,000, including principal, from an investment fund at the end of each year for the next 9 years. What should the required initial investment be at the beginning of the first year if the fund earns 11%? So again, I have a series of cash flows. The amount is at the end of the period. The amount is 120,000. 9 years, 11%. So let me write this down over here and see what we're looking at. So in this case, what we're looking at over here is I have $120,000 that will be withdrawn 9 years, so 9 times. The interest rate is 11%. Again, I'm looking up the present value of the ordinary annuity. I have a series of cash flows. I want to know what the present value is. So if I deposit 664,664,446 right now, for the next 9 years, I can withdraw $120,000 each year. At the end of 9 years, I'll be left with zero because the intention is everything comes out at the end of the period. There's nothing left over. Now, this would be perfect planning if you were doing, say, saving money for college and you knew it's going to take you exactly 4 years. And at the end of the 4 years, you don't want to have anything left. If you're doing retirement planning, that's more ambitious because you're trying to decide how long you're going to live. But this is an example of how you plan to have a certain amount of money right now in order to make these withdrawals moving forward. So in this problem, you've looked at different applications of the present value table. In each case, you need to identify what amounts have been given and what question is being asked of you. In part A, again to review, you were asked what's the gain. In part B, you were asked what's the bond selling price. In part C, you were asked how much would you record the machine at. In part D, you were asked how much would you record the tractor at. Difference over here was there's the initial payment in part D. In part A, C, there was no initial payment. And finally, in part E, you're told if you want to have a series of cash flows for the next 9 years, how much do you need to have right now? That's a present value calculation over here again. So once again, different situations, review each of these carefully and make sure we know what we're looking